Continuing on from internal controls and financial documents, this is looking at the third method, which is an income statement, also known as a profit and loss account. So understand why an income statement is recorded, explain the layout of an income statement, and if you wish to move on to this one, create your own personal income statement. Okay, so first and foremost, what it is, income statement or profit and loss account, it shows over a period of time a firm's or a company's sales revenue against and compares it to all the relevant costs that are generated to earn the revenue, and therefore looks at the difference. If the difference is positive, it's a profit. If it's a negative, it's a loss. So this is a very significant document because there's lots of people who are interested in what it says. Effectively interested in that final figure. Is it a profit? Is it a loss? And how much? And compared to the previous years, has there been improvements or not? So when it comes down to it, stakeholders involved in want to see P&L. As an example, shareholders will get an idea whether or not they're going to receive some sort of dividend on their shares. The government are always going to be keen to know because of tax purposes. Suppliers are going to be very keen to see the profit and loss account, the level of profit, because if it's profitable, that means that suppliers are going to be ordered some more. If it's not profitable, it means that they may be cutting back on their supply. So it gives them a knock-on effect to other people's businesses, particularly suppliers, and people who are potential shareholders and bankers, people who are investors into an organisation. They will look to see, okay, how much profit or how much losses have been making to aid their decision as to whether or not they're going to invest in this organisation. That is just for many stakeholders who are keen to see the profit and loss account. Not all companies will reveal their profit and loss. However, those that do, these will be the type of reasons why. That there is a legal requirement to do this one, particularly for tax. So, added to that, from an internal point of view, from the internal control, it does measure the success of a business, particularly when compared to the previous year, compared to the objectives or expectations. It helps them to obtain loans, okay, and it just gives an idea of how they can plan ahead. So, if the organisation is a PLC, it has to publish its income statement. That's one of the requirements. If they're going to be selling their shares to the public and anyone can buy it, anyone has the right to know their state of profit and loss. Lots of companies have lots of different business ideas over a period. Business interests, and over a period of time, what they might tend to do is consolidate, put all these businesses over a period of time together to make what we refer to as a consolidated, simplified PLC, rather than looking at all of their business interests. Okay, so the Companies Act does make it out a legal requirement. Every single organisation has to have one of these profit and loss accounts or income statements. Okay, so here we can see there's an example of a profit and loss document or an income statement. So what we see here at the minute is our sales turnover. So this is the money that's coming in. So 47,800, and from that, what we can see is that all of this stuff here is what's been paid out to create something that can be sold to create that figure. So we can see that they credited 47,800 in revenue and what they sold. It's cost them 27,700 to their costs, and that's given them what we refer to, a very important figure, a gross profit figure of 251,000. Now, what is significant here particularly is this is called the trading account, and these costs here only refer to the costs in making the good or the service. Okay, and so from that point of view, what we can see is that from here, this does reflect this gross figure. However, that is not all the costs that need to be paid off. Underneath, we see this is the actual profit and loss account part. Okay, and this is the further taxes that possibly might not be directly linked so much to the production of the good or service. So things like advertising, distribution, rent, wages and salaries. Some are more linked than others, but largely speaking, it makes that distinction between the two. So what we also see is taxation gets popped on there as well. And then we get this profit after tax. Another term is net profit. And this really is the profit which the organisation sees at the end of it. Okay, the profit that the organisation can, do whatever they wish to. And underneath we can see, so after all of these costs have been taken into consideration, we've therefore got a figure of 6,075. That has therefore been split into dividends, so that means that the shareholders have got their amount, and that leaves over 2,075, which is referred to as retained profit. So this was put back into the bank. So what we can see from this document is the money coming in, how they've generated, how they spent money to create that, in two ways: linked to production, others take away your tax, and this is the golden nectar effectively. This is the prize, the profit, and this is just how they've distributed it out to the owners, or if they put it back into the bank account for another day. Okay, so the income statement, very quickly, profit and loss. If it's made a profit or a loss over a period of time, split into the three areas: trading account, profit and loss, and appropriation account. So trading account, okay, difference between the sales revenue and how much it costs to make. This is the key bit. It's known as gross profit. Okay. On the other hand, in the trading account, that's all the other expenses taken away from the gross profit, and this is our net profit, or it could be a loss as well. Likewise, the gross profit could also be a loss as well. So lots of different expenses there. And the appropriation account is literally how it is distributed. Okay. Obviously, this has to happen. Okay, it goes out as tax, although that is taken into consideration up higher in the profit and loss account, but largely gets divided up to our shareholders in the form of dividends. Okay, and it could be retained for new investment in the business, or to be quite frank, the owners or whoever decides, they can do whatever they want with that money. So as a summary, we got a trading account, profit and loss account, and then the appropriation account.